The one big difference between a treasury bond and a corporate bond. Let's learn more. I'm a learning partner, Sushila Hariharan. If you're interested in a career in investment banking, trade life cycle, OTC derivatives, and hedge funds, do subscribe to my YouTube channel where we provide content centric, research focused videos on all these topics. Let's take a look at what are bonds and why are bonds categorized into treasury bonds and corporate bonds. As we know, bonds are fixed commitments, they're contractual obligations of a debt borrowing issued by the issuer and placed with different investors as a part of the capital raising activity by way of debt. So, what is the difference between bonds and normal debt? There is only one difference, and that is bonds are tradable. That means their ownership can be transferred from the seller to the buyer, but other debt instruments which are not tradable, the ownership cannot be transferred from the seller to the buyer. So, in the bond spectrum, also called as the fixed income securities spectrum, the bonds can be issued by either of the following entities. The first one is the federal government or the central government, in which case it's called as a treasury bond. In the United States, in countries like India, we call them as GSEC or gilt edged securities. The difference, this main attribute of such kind of bonds is that these have been issued by the government of the country. As opposed to this, we have corporate bonds which have been issued by different companies. Companies can issue bonds and place them either in the private credit market with a syndicate of investors, or they can issue bonds to the general public as well. This means that the bonds are issued by the corporate, and therefore the credit rating of a bond issued by the corporate is very different from that is issued by the government. The credit rating of a bond issued by the government is called as the sovereign risk rating. That means the country rating is attributed to that particular bond. So the sovereign risk is considered to be the cleanest risk in the bond spectrum because it is very safe. It is backed by government, promised to repay the investors and to pay the coupon on time. Since this backing is there by the federal government or the central government of that country, the treasury bonds are considered to be very safe and secure. On the other hand, corporate bonds have to be assessed for creditworthiness. Because they have to be assessed for creditworthiness on multiple parameters, including financial and non financial parameters, we find that the ratings of corporate bonds vary according to the creditworthiness of the borrowers. The ratings are assigned by independent rating agencies like S&P and Moody's, and the ratings move along the paradigm of AAA right down to BB, C as well as D. So a corporate borrower which has issued bonds must have an independent rating assigned by an independent rating agency, and only then it can float its bonds in the public market. The difference between a corporate bond and a government bond is this. That is, a government bond is backed by sovereign risk, and that is backed by the government. The default risk in this case is almost zero. Why I say almost zero? Is it not exactly zero? Governments never default. But there have been few cases in the past where governments have defaulted in repaying back their own investors or their own citizens who were invested in them, like in the European crisis where Portugal, Italy, Greece, Spain defaulted on paying to their own citizens the money back. So therefore I say it's almost zero. It is almost negligible. The risk of default by the government to its own investors, to its own citizens is almost zero. Whereas a corporate borrower doesn't have that kind of banking. The backing that the corporate borrower has is in terms of the assets that it is owning, and the assets can be collateralized to the lender. So, therefore, corporates have different credit parameters for assessing the credit worthiness, and hence we must remember to assign the credit worthiness across the parameter. Therefore, independent rating agencies like Standard and Poor and Moody's assign these ratings depending upon multiple factors that contribute to the credit worthiness of the issuer. The corporate bonds don't have this kind of ratings and therefore have different risk perceptions as assigned by the ratings given by the independent rating agencies. If the ratings are triple B and above, then they are called as investment grade bonds. If they are triple B and below, it's called speculative bonds, and bonds that have already defaulted are called as junk bonds. So, investors who are risk averse prefer to invest in treasury bonds, which have the sovereign risk rating, and investors who are having the ability to take up high risk or do not mind being exposed to a degree of credit risk, okay, will be willing to invest in corporate bonds of different ratings. That is a big difference between corporate bonds and government bonds. Thank you so much.